Sydney's deadline? So I think it was Tuesday. Okay, so we'll do American Express on Tuesday. If they haven't done three, I know. They haven't done any of them, they have to do the paper. Now they can only get an HP if they do the paper. I mean, this is okay, right, I understand. Alright, so we'll do it that way. Alright! I have an announcement to make about turning in these three write-ups. As Ben points out, not today, but the three over the course of the term. As Ben points out, it's a really minimal requirement. On American Express, because we're not going to discuss it in class, you can turn it in until Tuesday. You have to send these assignments to the TAs. If you send them to me, it is the same as feeding them to the dog. They are not going to get graded or looked at. Is that clear? So you have to send them to one of the TAs. Now, if you have not either arranged to send them directly before today, the WellPoint assignment, and doing the American Express by Tuesday, you have not done three write-ups. Then you have to do the optional paper to get an HP. Is that clear? You can't turn in other one-page write-ups late. It was a relatively light requirement. If you have not met it, and how many people have turned in no write-ups so far? Nobody wants to admit it. There are substantial numbers who have. What you have to do is do the paper. Now, what that means is, since the deadline for the paper is close to the end of term, and I'll let you do that, you will wind up with an incomplete for the first half semester. But as soon as you turn in the paper, we will then submit an HP. But you can't get better than an HP if you haven't done the three write-ups. And if you do a really crappy job on the paper, it won't count. Okay, so there is a punishment for not having done the minimal amount of work that we required of you. Are there any questions about that? Ben said there better not be effing questions. I would not email my one-page write-ups to Ben. All right, so you know what the requirements are. Any questions about that? All right, today I want to talk about WellPoint. The lucky winners are... Is Mark Scott here? All right, Mark, what I want to do actually is look at this sort of at the end of 2008, early 2009, when it was trading at about $30 a share, although you can look at it today if you want. But back then, or subsequently if you want, what do you think? So Obama's just been elected. What do you think of WellPoint as a potential value investment? Okay? So would this turn up on a search strategy if somebody came to you and said, I have a great idea for an investment, WellPoint, that's $30 or $32 a share? What would you say to them? What would your immediate reaction be? Next is Christine Seah, S-E-A-H. Oh, Christine, okay. What you're going to do is tell me about the nature of the company. That is, how far some of the concerns that Mark has evinced may apply in practice to WellPoint. What's the nature of the business? What's good about the business? What's bad about the business? Now, the lesson here, and it's going to, I hope, resonate when I talk sort of, because this is the last time I really have at you, because we're going to have speakers, and I'll explain in a second about the speakers for the next three classes. The lesson here is that you should never dive into the numbers right away. A good understanding of what you're looking at, what the parts are, what the nature of the business is, whether this is a promising potential value investment in terms of a reasonable search strategy, is the most important place for you to start before you go nuts on the numbers. Now, I know you all will love the formula, but I'll tell you a little secret. Until we write the next edition of the book, which we're in the process of writing, which is what you're the guinea pigs for, you will not remember the formula. What you will, I hope, remember is what a sound investment process looks like, and it's going to start off with these general things. Okay, Arden Sedigan. Okay, Arden, what I'm going to want you to do is an asset value. And what I want you to think about, particularly when you do the asset value and look at what the assets consist of, is this issue of the float, which is there is an item on the balance sheet which is a liability, which is called policy liabilities. And I want you to think about how you're going to evaluate that. Thomas Cervantes. Thomas, what you're going to do is do an earnings power value for me, and in light of the asset value that Arden did, you're going to say whether you think this is a franchise, whether this is a business protected by barriers to entry. By the way, there is an issue of franchise, what we mean by the word franchise here. We're not talking about McDonald's. Somebody came up to me and said at the end of class last time, you mean like a franchise business, like a franchise, Mako mufflers or things like that. The language we are using is this a business protected by barriers to entry? What that is the same thing as, is this a business that enjoys incumbent competitive advantages in certain markets? Ultimately, the language that's used for that is businesses with those two, or that characteristic, barriers to entry created by incumbent competitive advantages that you hope are sustainable, are what we refer to as franchise businesses. So I'm going to want to know what the earnings power value looks like in the nature of this business as a franchise business. Is Moran Shekel here? Okay, what I'm going to want to know for you is, do you want to pay for the growth of this company? As a growth stock, what kind of a return do you think you're looking at? And is it worth worrying about the growth? That is, do you agree with Thomas about the existence of a franchise? James Shelton. James? Okay. James, I want to know what the downsides are that you see here. What are the things that you'd worry about if you wanted to get your arms around what could go wrong here? So we ought to have a pretty good picture of sort of what we're buying in terms of assets, what the returns are, what the nature of the business is. Your job is to say, what are the diseases here and how serious do we think they are? And if they turn out to be serious, what's going to happen to us? And I'm going to try and do this, Brendan, although I didn't succeed in doing it last time. Is Brendan Short here?
Yes.
Brendan, you're just going to have to say yes or no on whether you'd make this investment at $30 a share. And don't be put off by the fact that it's close to 60 today. Okay? All right, having said that, while they're getting ready, what I would like to do is just for the last time give you a chance to ask questions and talk through what we are concerned with when we talk about a value process. Remember, it is first and most importantly a search strategy. It is the idea that in a world where there are two sides to every trade, to be on the right side of the trade, You want to take advantage of systematic, individual, and institutional irrationalities. And what those consists of are the things we've talked about. Get-rich-quick lottery preferences. Blockbusters that institutional firms like to talk about. Loss aversion to things that are ugly and potentially prone to serious losses. And third, this over-certainty that people have. And I guarantee you, I suffer from that disease. I am more than sometimes wrong. I am never uncertain. It is something you want to take advantage of. Those three together mean that ugly, cheap, overlooked, obscure stocks that are otherwise ignored are likely to be undervalued, and glamorous, prominent, attractive stocks are likely to be overvalued. That is probably the most important thing you have to remember. The first speakers that we have are going to talk to you about literally just implementing that kind of a strategy with some sensible adjustments for what you can know from the statistical data. So one way to do value investing is simply to do the kinds of statistical portfolios that Tano talked about. And if you do that in a disciplined way, the evidence is that in every country in the world pretty much, and in every extended time period, you are going to outperform the market by somewhere around 3 to 5% on the long side, and if you do the long-short strategy that Tano talked about, you could outperform by 5 to 6%. Now, the fraction of money managers who do that in practice is minuscule. So if there is an important place to start, it is to understand that regularity and the supporting statistical data that Tano talked about. Are there any questions about that? Because this is my last chance to turn 100% of you into real value investors. Okay. Next, you want to be good at valuation. You want to know in detail what you're buying. You want to break the information that you have about the value of these companies down in the most revealing possible way. And what the most revealing possible way means is that you want to use all the information, and you want to array the information in a way that makes transparent the impact of the assumptions that you can really make about the long term on valuation. And you want to start with the most reliable information. The second best thing you can do as a value investor, and you should recognize this from your experience in valuing companies in 6301, for those who did it, is start with the balance sheet. That is there, that is tangible. Unless you've got a franchise business, what you're going to get in the end is the earnings that justify that asset investment. So that's usually where you want to start, and in some cases, like natural resource businesses, where the earnings, because of price volatility, are very unpredictable, it's those asset values that are going to anchor, more than anything else, future value. So the second thing I hope you remember is, whenever you go to a company, what are you going to hear about first from Wall Street? You're going to hear about future earnings, and you're probably going to get a price-earnings ratio. Start always looking at the balance sheet, even if it's obviously a franchise business. Then, forget the growth. The growth is going to get you in trouble, and you should know that. So then look at your best estimate of the average earnings power of that business as it sits there today and convert that into an earnings power value. And if we go to the growth, that's fine later. The benefit of doing that, in addition to concentrating on what you can know reasonably reliably, rather than things that are predicated on all sorts of dreams about the future that we know from the historical behavior of growth stocks are going to get you in trouble, is you're going to get a picture of what's going on that ought to guide your research. And it's a picture that looks like this. And this is the third thing I hope you'll remember. I'll tell you a story, by the way, about what you'll remember, because it's worth saying. The first time I ever had a truly impossible teaching task to do was when I taught managerial economics, which is not your managerial economics, but is really more your operations course and statistics course at Harvard Business School. And I had 5 classes to teach them everything they needed to know about regression. And I had to do it in the context of case study discussions. And I thought, okay, this is a complete waste of time. So I asked the guy who was sort of notoriously the best teacher of this material what I should do, other than just not bother to show up for class, which was my strategy. And he said, look, he said, it's really easy. Just tell them the 5 things they need to know about regression. And I said, great, thinking I'd say, what are the 5 things? He said, I have no idea. I make them up every year, but they're going to remember at most 5 things about regression. So tell them the 5 things that you need to remember. The 5 things that I hope you will remember about value investing is, first, the general point about search strategy. The ugly, cheap, out of favor. Second, start with the assets and then the earnings power. Start with the things you can really know. Third, understand when you've calculated those 2, the story that they tell. The first possibility is this one, where you've got a lot of assets and you don't have a lot of earnings power. You want to think of that, think of Hudson General in the hands of the creeps who are running it. That is mostly where that situation arises. What it means is you've got to think about getting rid of management. And if nobody is doing it on the horizon, then you're probably not going to make that investment on an asset basis, because you're not likely to see any return on those assets until the management is well on its way to being ousted. That means the proxy statement is probably the critical thing. There is another thing, by the way, that story will tell you. Mike, are you here? Oh, he's not here today. Okay, I'm going to give him credit. Sometimes it means you're being too optimistic about those assets. That they may, like Mike talked about the Magna assets in Detroit, be assets that really don't have any earnings power associated with them because of an industry decline or other things. So you do want to go back and check to see if those assets are real assets that somebody else can make use of. And that's the fundamental test. So you're going to see a situation a lot of times like that. Now, the classic case where that exists today is in what industry? Does anybody here actually look at stocks in the United States? If you look at the merchant power producers in the United States, they are all selling at tiny fractions of the reproduction value of those power plants. Now, the problem there is the Mike problem, which is there's a lot of overcapacity, and it's not clear when you're going to realize, in terms of the rates you get, the full value of those assets, although they're also trading, by the way, below reasonable estimates of current earnings power. Then, of course, you've probably got to try and figure out when is new capacity going to be needed, and you've got to discount back from that date, say 4 or 5 years in the future, the reproduction value then to today to see what those plants are really worth. So that's the second possibility. And that should guide your research effort, because you're going to be buying the assets probably in that case, and you want to make sure the value of the assets is going to be there and it's going to be realized. The second situation is more or less the Magna situation. It's where you have the earnings power and the asset value roughly equal. By the way, that also tells you what about the cost of capital and the return on capital that they're earning on average. Tells you they're the same. So there are lots of ways to calculate a return on invested capital. And they may give you widely divergent answers depending on how you do it. But really, often you get, so if you do it for Dell, you take out the excess cash or the putatively excess cash. You'll see you have an enormous return on assets. The same for Amazon. That is presumably because there are lots of elements of invested capital, mainly in the intangibles, that are missing from the denominator of that equation. If you do things properly, earnings power should reflect the after-tax earnings potential of the business on average, which should be the numerator of return on invested capital, and the net asset value should represent the capital you've got to invest in the business, minus, of course, the non-business assets, and that ought to give you the denominator for return on investment. So the case where the two are the same is really the best, most comprehensive measure of when the return on invested capital is equal to cost of capital. Because remember, the earnings power value is just the earnings power divided by a cost of capital. You equate that to the asset value, and you just bring the R, which is the cost of capital, over the right-hand side, and the earnings power over the asset value, which is the return on invested capital. You'll see immediately that that's the case. You can triangulate further in that case by thinking, is this a business that looks like it's got big barriers to entry, significant incumbent competitive advantages? Is this a franchise? And if it looks like it's not, and whatever franchise power there is in the long run in Magna is probably pretty limited, you have a pretty good, reliable, robust estimate of what you're getting there, even in the face of the fact that it is a sick industry. So the fact that at worst the Magna assets are worth about $9.5 billion, and you've got that much in earnings power value and excess cash, tells you a story about that value. And it tells you a story that you've got at least probably $90 a share in value. Now, how close to that you want to go is up to you. At $19 to $20 a share, obviously you ought to be ready to buy that all day long, because you're getting a big margin of safety. The last situation is one like Amazon, like I hope you found with WellPoint, where the asset value is substantially less than the earnings. Typically for those stocks, you are going to pay earnings, although the asset value is not irrelevant. That presumably what supports those earnings is a franchise, is incumbent competitive advantages, and you ought to know what they look like, and the barriers to entry that they create. So in that case, where your research is going to be focused is on just that particular issue. And it's something you ought to be reasonably good at forecasting. I do not know what Ford's profit margins are going to be 20 years from now. But I do know they're not going to have any competitive advantages over any of the big auto companies anytime in those 20 years, unless something truly bizarre happens. So it's a way of arraying the evidence to highlight what the critical issues are and to triangulate the data that is most reliable, which is current earnings and the reproduction value of those assets for viable businesses, to get a story that's broadly consistent and is also a platform for identifying where you're going to put in your research effort. Now, are there any questions about that? If you find yourself down here, if you're brave enough to try and invest in those companies, then the absolute first thing you have to verify is that there is a franchise there. What I mean by that is there are barriers to entry supported by sustainable competitive advantages. What do they look like? Almost always, when you cut to the chase, and this is the fourth thing I want you to understand, is you have to analyze competitive advantages on a market-by-market basis. That is, product by product, geographic region by geographic region. The big global markets like automobiles, where they're integrated through trade and other things, or consumer electronics, typically do not have sustainable barriers to entry. 10 years from now, what do you think is going to be true of the iPhone? You think it's going to be the dominant cell phone in use? Not a chance. For all you Apple lovers, people had thought the Razor was going to be the dominant cell phone. People thought Nokia phones were going to be the dominant cell phones. People thought Samsung phones. People thought the Walkman was going to change the world. People thought more recently the iPod was going to make Apple rich. You have to understand big global markets without customer captivity, where lots of people can be viable at relatively small scale, cannot be dominated by anybody, which means effectively there are no barriers to entry. If you invest in a franchise, what kind of franchise do you want to look for? Local, 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 either in product space or in geography. That is the fourth thing that I want you to understand. I want you, therefore, to understand where value opportunities are created. I want you to understand how you're going to value those opportunities. I want you to understand what the key issues are and how a good valuation procedure, and valuation starts with the asset value. So, a good search strategy, which is a value search strategy, an asset and earnings power approach to valuation, understanding the story that those results tell you, and then if you're going to buy franchises, truly understanding what those franchises are like. Now, if you are going to pay for growth, you're not going to just pay earnings, power, value, and hope to get the growth for free, which is where Buffett started out and drifted away from. Then ask yourself, at the multiple I am paying, what kind of average expected return can I get in the future? And here, the crucial thing about that formula, which I don't think you'll remember, so I'm not going to repeat it, is that it uses the information that you can reliably intuit today about the future. The earnings return, which is just the earnings power divided by the market price. That's where you start. The distribution policy, which companies usually articulate. Now, that could change in the future, but it's as likely to go up as go down. So how much gets paid out in cash? How much gets reinvested? The reinvestment return. What's the most important aspect of the reinvestment return? What's the one thing you can know for sure? And let's talk about newspapers, and let's talk about Amazon. What's the striking thing about the reinvestment returns, which is their ability to create value by actively allocating capital? It's pretty limited. When newspapers are dying, they don't have obvious places they can allocate that capital to markets that they dominate. So to think that they're going to create value through capital allocation is almost certainly false. And that means the more you get back, the higher the value of those earnings. Where is Amazon likely to be able to allocate capital that's protected by barriers to entry? Almost no place. Their core business, which is books, CDs, and music, is going away. Capital is leaving that area. It's not going into that area. Once Walmart had dominated the upper Middle West, where did they have opportunities to allocate capital? Well, at the fringes of the South Central United States, at the fringes of those areas. Once they'd exhausted the fringes of those areas and they announced they're going overseas, what do you know qualitatively has got to be true about their capital allocation process? It's not going to create value. So to get a number, a multiple above 1 on the value created by the retained part of earnings requires that there be expansion opportunities within the markets or at the edges of the markets that these people go. And your first step ought to be just to make that qualitative judgment about the potential for value creation through active capital allocation. And finally, you get the organic growth, which is just the growth in that market. Now, it's easy actually to get the effect of the organic growth. You don't have to project the growth for company XYZ. Why? Because if there are barriers to entry, what's true of market shares? They're going to be stable. And if market shares are stable, at what rate is this company going to grow? At the rate of the market that it's in. That market, if it's to rich people and it's for services like medical care, may grow slightly faster than GDP. If it's for goods, for working stiffs, it's going to grow substantially less rapidly than GDP. But again, that's information that you can know, and translating that information into a return is something that you can do relatively straightforwardly and relatively easily. So the principle you want to take away from this approach to valuation is it ought to enable you to forefront the assumptions about the future that you can reliably make, and there ought to be a straightforward connection between those assumptions and either the asset value or the earnings power value or the total return that you're likely to get in the future. And that is the fundamental principle in value investing. It's not, however, that's just philosophy. It's not the fifth thing that I want you to know. When you think of what I've talked about is that if the valuation rule is appropriate, starting with the assets, then the earnings power, then the story. And those are the three things about valuation I want to remember. It ought to identify the key issues and the collateral evidence and things that you just ought to naturally do. What are the insiders doing? What are other intelligent investors doing? And then there's the issue, and this is the next thing I hope you'll remember, there is the issue of your personal biases. You have to monitor yourself. And sometimes you're lucky, like me. I say things in the newspapers. I screw up, improving my language here. And I get 10 to 15 emails saying, you see, you made a stupid mistake. And I save them all. And think about that mistake. But you have to track what you do. In terms of risk management, so those are the 5 things I want you to remember. I want you to remember a value orientation to search. I want you to remember when you do valuation, start with the asset value, then the current earnings power value, then the story. Get fancy about valuing growth only in that context. finally, I want you to monitor what you do yourself. In terms of risk management, the most important part of it proceeds directly from those 5 principles. The first is, and that's margin of safety. If you're looking for undervalued stocks, you want a gap between that carefully calculated or calculated as well as possible value you've got and the price at which you're getting these things. And that involves really the 5 things that we've talked about. You apply them in a disciplined way, you'll be fine. I think the important parts of risk management beyond that to remember is you are going to make mistakes. Unless you are as smart as the young Warren Buffett or even the old Warren Buffett or Glenn Greenberg, you don't want to have less than 10 stocks. You probably want to have 20 or more, and those mistakes ought to average out. So you want some diversification. And ultimately, what your biggest enemy is impatience. It's deciding, and this comes back to your personal behavior, deciding, well, there may not be any great value opportunities here, but hey, I got to invest someplace. If you force yourself to do that, you're going to get into trouble, because discipline, since you're taking advantage of natural human tendencies in everybody else and natural irrationalities that apply to you too, you want to not be impatient and give in to those. So you want to have a well-thought-out default strategy. In addition to that, obviously you probably want to avoid high leverage, both in your portfolio. If you can remember to do it, try and get a balanced macro exposure to inflation and deflation or recession. And if you're really clever, you can buy insurance, but that's a separate course, and I don't expect it. Are there any questions about that? The fact that I can say the whole course in 30 minutes is probably more important than anything else before we start talking about wealth. Are there any questions about that? Yes.
It's going to sound a little lame, but when you use the matrix that's in the book,
don't use the matrix in the book. That's an easy question. What is the point of the matrix in the book? Where G is sort of the long-term growth rate without dividing it up into sources of active growth. What really is the message of that matrix, which is all we really do? It takes a lot of growth and a powerful franchise to generate a huge amount of value. Above the earnings power of the Okay, so don't worry about the detail. If you want to worry about the detail, come in my office, because it's the waste of everything else. It's also a waste of your time. It is my job. Yes? 7%. Now, can I stop you right there? Because that's an absolutely typical stupid comment that people make. And why am I saying that? What's the missing element in that statement? 7% of the return. 70% is the market return. What am I going to ask you about that 70%? No, but look, over what time horizon is 70% of the return the market? In a day, I'll bet you it's 90%. In a month, I'll bet you it's 80%. I suspect your 70% is an annual number. Are we investing with that time horizon in mind? Over 10 years, do you think it's 70% the market? Over 20 years, do you think it's 70% the market? Can you make sensible investment decisions that are valid for 10 years? Can you hold a stock for 10 years sensibly, assuming the price doesn't get too high? The answer is yes, of course. When you look at the value portfolios that Tano identified, do they produce these high, steady returns all the time? No. They produce them over long periods, but there are periods as long as 20 years where they underperform. What are you betting on when you approach things this way and decide not to worry that 70% of it is the market? Sorry? Okay, you don't go bust before this happens. Do you think you're likely to... what is the one thing that's going to make you go bust? Stupid investors is one. Shorting is another that you kill you. But what's the one that's really going to kill you in the interim if you get caught on the downside? It's leverage. If you're unlevered, if you have no debt, is it easy to go bust? The companies you own have relatively little debt. Is it easy for them to go bust? If that's the case, all right, now let's go back to your statement. Go ahead. Finish it.
That was my point of saying, well, looking at our strategy, actually wait
On average, if the strategy is a good one, should it outperform in the long run and the short run? It should outperform also in the short run. When Tano showed you those portfolios, the former French portfolios, how often did they rebalance those portfolios? At the end of every month. And by picking the cheapest stocks at the end of every month, and you could imagine shorting the most expensive stocks in terms of market book, at the end of every month, how well did they do? They did well. Was that return significantly correlated to the market? You went long short. In the long run, what is your objective as a professional money manager? No. Can you guarantee absolute returns? Well, look, let me ask this again. Can you forecast this year's return in the stock market reasonably accurately? No. Can you do reasonably well on the next 15 to 20 years' return in the stock market, on average? Yes, that's a number that's historically a lot more stable. What's your goal, therefore, as an investor who's wasting the time to invest actively? Outperform the market. And to do it in the short term or in the long term. In the long term. So if you make a succession of sensible short-term bets, what does Tano's evidence tells you you'll do in the long term? You won't do well? All right, let me go back. How did Tano select the portfolio for, say, the beginning of December 2008? Okay, no, that's a different. That's the bond portfolio. How did Fama and French do it? They looked at the bottom decile of stocks by market-to-book ratio, or the top decile by book-to-market. Okay? And they shorted the top decile by market-to-book, which is the bottom decile by book-to-market. And they did that portfolio. How frequently, is that a portfolio that ought to perform well in the long run? Yes, it is. Those are things where you've got all these behavioral influences on your side. But how often did they change that portfolio? Every month. So they made a succession of short-term investments based on long-term principles. How well did those portfolios perform relative to the market? They beat the market coming and going. So now I come back to your statement. Does it matter that 70% of return in an appropriate time horizon is based on the market? Not really much. There is, however, one germ of, I think, important insight in what you're saying. There are going to be times where markets are, as a whole, are ridiculously priced. Japan in 1989, internet stocks at the end of 1999 and 2000, how home builders in actually 2005, 2006, all sorts of real estate-related stocks in 2007. How are you going to recognize those situations? Well, by doing a sensible valuation. And what that sensible valuation is going to tell you is there is nothing out there that looks like it's going to produce a decent return, or you're getting it at a price substantially below its asset value and reasonable earnings value. If that's the case, what are you going to do? You're going to probably have a lot of cash, or if you're in the market, you're going to have a lot of insurance. When the market keeps going up, how are you going to feel? Terrible. But in the long run, what's going to happen? Normally I concentrate, because I think it's valuable for you, on my investment failures. But I'll tell you the one which was a spectacular failure in the short run, but in the long run worked out. In late 1999, I thought Juniper Networks was never going to be worth anything. Because if they could get in against Cisco, it meant there were no barriers to entry and somebody else was going to get in against them. And if they couldn't get in against Cisco, they weren't going to make money, and they were trading at like 80 times earnings. So I shorted it at $180 a share. Within 5 months, I'd say it was at $360 a share. I shorted it again at $360 a share. So the average short was at $270 a share. That short is still on. What do you think the price of Juniper is today? It's about $30 to $40 a share, maybe below that. Is that a surprise if you've got a sound valuation? No, that's not true. You think that's universally true? On average, over the last 50 years, what have stocks done? Risen or fallen? Okay, I'm going to stop this here because I do want to talk about wealth. But remember this conversation. What is he doing? What he is doing is telling himself a story so he can get into that market and have fun. Predicting stock prices, shorting stocks because after all, everything falls sooner or later. Riding the wave. As long as he is on the other side of the trade, you are in good shape. Does that answer your question? All right, so let's talk about WellPoint. What kind of a company is WellPoint, and is it a value investment? I'm going to try and actually use the board here. All right, Mark, you're on.
Okay, so it's a diversified starting advanced carrier.
Okay.
That's got
hold on. Let me start with. So it's got about 60 billion in revenue, close enough. It's got 45,000 employees. 35 million customers. And how many states is it in? 14 million. Okay, but it's in 14 states. By the way, what are some states that it absolutely dominates? Well, no, California actually dominates, I think, northern and central California. But it's got a lot in California. Is it in New York it's big? Is it big in the city?
Yeah, it's got New York City, especially the metropolitan area.
Okay, so New York City, it's actually the metropolitan area. It's not so much downtown. So it's actually the New York suburbs and Connecticut. Any states that it completely dominates. It's got 90% of the business in Maine. 90% plus. Colorado. Okay, so all those customers are concentrated in 14 states, and in some cases in regions of the state. I think it's in North and Central California, because I think Kaiser is completely dominant around LA.
The other big thing is it's the blue licensee for Blue Cross.
Okay, so it is Blue Cross Blue Shield.
Well, not every.
Right, in those states. What about this as a value investment?
In terms of whether it dominates local markets.
Well, no, that I don't want to start with yet. I want to start with just, is it cheap? Is it ugly? Is it obscure?
I wouldn't call it obscure. It's
Well, what's the market cap roughly?
right now, it's doing 60, so around 30 million.
Okay, but let's say when it was 30, it was actually about 15 billion. Is it widely covered? Did anybody look at that? 10 to 20 analysts. So it's not Microsoft with 100, but it's not. It's a leading healthcare stock. So it's probably not obscure. Anything else? Mark. Well, all right, let's talk about that. Obama's just been elected president. It's November to March 2008, 2009. I mean, what is this company? What kind of... It's a health insurance company. How do people feel about health insurance companies? How does Obama feel about health insurance companies? In fact, what has this company done recently that's endeared it to Obama? Anybody? Raised premiums by 38% on some poor schnooks in California. Well, is this an industry that looks like it's got headwinds or tailwinds? Anybody? Headwinds. I mean, everybody hates this. And where does it show up? Even before the market crash, how had this stock been doing? Do you all get the value line tear sheet, which was, so you ought to have a fairly long price history here. Anybody, when did the stock price peak? End of 07. And what was the price at the end of 07?
$90.
No, 90 to 100, 90, 95. So the price at the end of 2007 was $90 to $95 a share. Where is it today? If we're talking about end of 08, early 09. No, that's today. I mean, I'm talking about it. We're looking at it there. Got down to $30 a share. And it was there for actually a reasonable amount of time. Does that tell a story of a stock that's really healthy, that everybody loves? What did the market fall by in that period? Did it fall by 70%? And in fact, should this stock be more or less stable than the market. Should be more stable. It's a very stable business, healthcare. Automobiles, forget it. Home building, forget it. But what about healthcare? And if I came to you in February of 08, or I came to you in November of 08, I'm sorry, February of 09 or November of 08, and said, I have a brilliant stock for you. And they said, oh, great, what is it? And I said, it's a health insurer. What would your reaction be? Hot damn! Is this the Apple or the Amazon of the stock market? So is it despised? Okay? It is pretty much. So there are issues, let's call it that, issues in health insurance. By the way, is this the health insurer everybody loves? Does anybody check on the reputation of this company? Has it got a reputation for being well managed? If I tell you about the big health insurers, United Healthcare, which is the biggest, these guys, and Aetna, who is usually, if you read the sell-side research, the gold standard of health insurers. Aetna. Everybody loves Aetna for some reason. All right, let's start another tab. Where is their headquarters? Indianapolis. I mean, even with the Colts, it's a city of losers. And has this got a famous management team? No. In fact, did anybody bother to compare their sort of operating margins with the industry operating margins? Their payout rates are higher. Their overhead rates are about the same. Their margins are actually a little lower than the industry. So they do not have a reputation for good management. Well, is this stock cheap at that time? And you can see it on the value line tear sheet. Well, at a price of $32, if you've got that value line tear sheet, at the end of 08, what's the book value per share?
43?
$43 a share is the book value. And at $30 a share, therefore, if 30 is the price, 30 saying 32. That's trading at what, 75% of book value? Is that cheap or expensive? In terms of earnings, just a simple earnings yield. Anybody? What's the earnings per share in 2008? Almost $5 a share. So the earnings per share is about $5. And if the price is 32, that's about 6 to 7 times earnings. Is that cheap or expensive? So it's cheap, it's not obscure, but does it look like it's disease? You think this thing has problems? Now, you can decide not to look at it. But with this profile, if this were a good business, would you be really potentially interested? Okay. Mark, anything else you want to add before I go to Christine? Tell me about the nature of the business. Okay.
There are 4 things good about this business. First, there's customer stickiness.
Okay, so now Christina is going to tell us about the business. Who are the customers?
Personal and corporate employees.
Well, who actually signs up?
They sign up with Blue Cross and
Okay, but is it, so they're individuals, and there are companies. And let's think about those separately. If you're an individual, is it easy to get health insurance? If you try and, it's not easy at all, because what are they all worried about? Adverse selection. What is adverse selection in health insurance? Sorry?
You have a bad health conditions.
Yeah, that you don't go get insurance, then you get cancer, and then you say, okay, now I need insurance. So you wait until something is wrong, and then you get insurance. Who knows better the state of your health? The health insurer or you? You. So, yeah, with luck, you. So you're always worried about adverse selection in individual health care. Once you've got health insurance, is it easy to switch? Not a chance. What's my automatic assumption if you decide to switch from, I'm Aetna and you're coming from WellPoint? Who knows more about your health, WellPoint or Aetna? Sorry? You've been a WellPoint customer for 3 years. And all of a sudden you decide you want to switch to Aetna. WellPoint. Why are you likely to have decided to switch to Aetna? Because they're giving you a better deal. If you were a good customer at that price that Aetna's offering, would WellPoint want to keep you? Yes. So what are the odds that you're a good customer at that price, given that WellPoint is willing to let you go to Aetna? And this is one of the reasons why people want portable national health insurance. You suddenly want insurance from Aetna because WellPoint, you're not happy because they're not going to insure the way they're going to insure you? I guarantee you Aetna's not interested for the most part. And are they going to put you through a lot of tests before they accept you? Yes, they are. So is it easy? Is there a big switching cost here for individuals? Yes. So if you think about the nature of this market, there's huge customer captivity for individuals. And what about companies, though?
right, economies of scale.
Well, no. Let's just think about a company switching.
Like there's brand loyalty and
Well, there's that, absolutely. Is it easy for a company to switch its health insurance provider? Because what happened, yes?
Depends on largely where the company has their employees. Is there another plan that has as many doctors?
Doctors, exactly. But are some of the employees going to have to change doctors because they're not covered? They're not affiliated. So is there switching costs here? Yes, there is. There are administrative costs. So we'll accept, I think, Christine, that there's definitely customer stickiness. What's number 2?
economies of scale.
Right, okay.
Customer captivity together.
Okay, so you've got customer captivity. What about economies of scale? Where do they come in?
We have the largest network coverage.
Well, why would you want, let's look at from the customer side, why would you want a health insurer who's big rather than small? Christine. Well, from the cost perspective, what are your fixed costs typically? Information systems. But is that really a big cost? Does anybody have a feel for how much those cost? I mean, they're in the process, by the way, of a huge information systems overhaul. You know how much it's projected to cost? $200 million. Is that a big cost compared to the $60 billion a year in charges? To take those 45,000 employees that Mark identified to do the systems? What do you think those 45,000 employees are doing? Well, they're processing the benefits. They're signing up doctors. They're negotiating with doctors and hospitals on rates. And they're selling. They're out there selling to companies and to individuals. Are those costs fixed or variable? Well, claims processing has some big fixed cost of infrastructure, but then it's variable. What about the coverage of the local doctors and the local companies? Is that fixed nationally, regionally? Regionally. So we've got fixed costs, we've got a big fixed overhead for negotiation and sales and administration regionally. What about for the customers? Would you prefer a small or a big health maintenance organization?
Big one.
Why?
So that you can go to the concerns off.
Doctors. Do you care about how many doctors they have in Houston if you live in New York? Do you care how many doctors they have in LA if you live in New York? So this network effect of wanting to go with the company that has the most local doctors, because that gives the customers the most choice, and if they've got the most customers locally, what do the doctors pretty much have to do? Sign up. That's a classic network effect. Is that a local or a national network effect? That's a local. So you've got local economies of scale and a local network effect. Anything else about this business?
There are high barriers to entry.
Well, presumably these two together means it's impossible to enter. But is their strength local or national?
Local.
So does it matter that United Healthcare is bigger than them overall? No, in their regions they absolutely dominate. Who is the most powerful HMO around? It's these guys. They are far and away the most geographically concentrated. Aetna is all over Hellendon. United is pretty spread out. And these guys are just in 14 states with an average, if you look at that, of 2.5 million customers per state. And even within the states, if you look, they're really concentrated. So given that captivity and their economy of scale advantages, what would you imagine is true of their competitive position? It's extremely strong. Anything else that's good about these guys? Well, do newspapers have strong competitive positions? I'm going to try and get you out of here. This is going to happen fast in the end. Do newspapers have strong competitive positions? No, they do not. Why? I mean, yes, they do, rather. But why are they not good investments? They're a dying business. Are these guys in a dying or growing business? They get a percentage of health care. And what are health care expenditures growing by? 6 to 7% a year. So the next thing that's good about these guys is they're in a growing business. Can Obama do anything about that? What about the threat of regulation, given these competitive advantages? What's Obama talking about doing? Universal coverage. Is that good or bad for these guys? As long as it's not the government that does it all, it's obviously good for these guys. Because if their market expands, who benefits? Them or their less concentrated competitors? If he puts a limit, and these are the laws that were being talked about in California, on the amount of administrative fees, that is the fraction of premiums that can go to administration, is that going to help or hurt these guys? Help these guys. Why? They already have economies of scale and they're already under the limit. Now, the shocking thing about these guys is with all this embedded advantage, their overall margins look slightly worse than everybody else. So is there room for improvement here or not in the management of this company? The quality of management is pretty crappy, but it has only upside. And the fact that it's so crappy means it's not threatened by the government. I want to come back to you, Mark, because you wanted to talk about this. So is this a great business, a good business, or a crappy business? It's a good business. Is the government ever going to be able to get rid of these guys? By the way, not a chance. Why? If you're going to control health care costs, what do you have to do? Drugs are, by the way, 10 to 12%. Can you do it cutting the price of drugs? Not a chance. Their administrative costs and profits are 5 to 6%. Can you do it cutting that? Not a chance. What has the government got to do to control healthcare costs? Yes?
It needs to be a general disease management program.
Right, it has to say no to people. If you have a disease and they're managing it and they don't think you should get this treatment, they say no. Is that one of these guys' jobs? Is that what they do for their insurer? HMOs are in the business of controlling costs and saying no. Is the government good at saying no? Do we have a lot of evidence for that in Medicare and Medicaid programs? Yes, we do. Given that reality, is the government ever going to get rid of these guys who have the local economies of scale? Not a chance. So is this a good business? Yes, it is. What about the asset value of this business? Quickly, and here I'll just, if you want to give me a number, Arden? No, just the net asset value. Try again. What do most of the assets of this business consist of? We do an asset value. What do the most of the assets of this business consist of? Well, I've got a book value of equity of $21.4 billion, but I've got goodwill of $22 billion. I've got net cash to take out of that. I've got a slight PP&E adjustment. You can write that up by a little, but they don't have a lot of property, plant, equipment. They got a lot of business intangibles, and the staff is probably slightly better than Amazon, but not as high quality as Magna. So say it's roughly Magna, 15,000, 10,000 workers. You get a net asset value of, after taking out the goodwill and doing the adjustments, of about $7.5 billion. But then you've got the net cash and investments of $8.67 billion. Where does that come from? If you look at that balance sheet, or you look at that balance sheet at the end of 2008 rather, you'd have cash, short-term investments, other equity investments, and accrued interest, which is really just interest you've got coming for the most part. It's actually slightly less than this if you look in detail. It's about $4.9 billion, close to $5 billion. Then you've got all these long-term investments of about $12.5 billion. And if you add them all together, you've got cash and long-term investments just off that balance sheet of about $8 to $17.5 billion. You've got debt of $8.8 billion. So you've got a net cash value of about $8 billion. You add that in, you've got an asset value, if you buy the whole company, including the debt, of about $16 billion after paying off the debt. That's the equity value. What's nice about that equity value? it's half cash. So you're getting this thing that's selling at 6 times earnings, and you're getting half your investment back in cash. Now, some of this cash is covered by what? Art, where are you? What have we sort of ignored here? Policy liabilities. What is that called in insurance parlance? Sorry? Right, but what are they? What's the term of art in insurance? That's the float. That's the float. Do they get to use that money, or do they have to not use it because it's going to go away anytime soon? For that free loan from the policyholders to go away, what would have to happen to their bills? They'd have to shrink. Is that likely to happen? So is that cash they can reasonably use as long as they're borrowing? Yes, it is. So they have all that cash in investments. Now, the bad news is these guys are unbelievably stupid investors. But they've gotten better lately. But in terms of assets, you're getting about operating assets of maybe $7.5 billion and net cash of $8.5 billion for your $15 billion. What about the earnings power? Did anybody look at that quickly? Want to give me an earnings power value, Thomas? Okay. Okay. Start with an average return. It could be 7. What was your number here for sustainable net income?
I used the revenue for employees.
Right, but that's about $61 billion. What did you use for sustainable operating margin? Remember that 8%, so yours a little higher. And then a tax rate then. The excess depreciation here, by the way, is just depreciation and amortization minus total investment. It's assuming all the investment is maintenance capex. You add that back, you wind up with about $3 billion in sustainable income, and a whack of 11, you multiply it by 9, you get about $28 billion in earnings power, and then you have to add back the cash. So you've got an earnings power of about $36 billion. Does those two numbers tell a story? Does it look like there's a strong franchise here this evening? Yes, there does. This is very different from Amazon. If you ignore the cash, you've got earnings power of $28 billion and operating assets of about $75 billion. So they also made money selling their prescription division, but fundamentally, is this worth buying for $15 billion? Even if there's no growth. Well, you've got a current earnings power value of twice the $15 billion you're going to pay, and half of it is in cash. And is the disease of this company already in these numbers? Is it going to go away? No, it isn't. This is, again, a huge bargain. What's the downside here? Sorry? Okay, what's the downside? It is James. Okay. Okay. Can I say that in slightly different terms? The mix of business is changing. Companies are hiring WellPoint not to provide insurance, but they'll cover the full cost of the medical services. They're hiring WellPoint to provide administrative services, negotiations with hospitals, payment services, negotiations with doctors. Should that change affect WellPoint?
Sorry, not that. So probably just taking knives off, right?
Right.
They used to buy PBM pieces.
What's PBM?
The pharmacy, right?
Right, these guys sold their pharmacy to huge. Right.
Like they still manufacture customers just as United has that code.
Right. Is that a big part of the business?
No.
Okay. What's the third thing?
The government creates a competitor.
Yes, single payer will kill these guys. How long would it take to get a single payer in place? 4 or 5 years. You take 4 or 5 years of earnings and they stop paying taxes because they run out of business. At what multiple do operating earnings are they trading? Well, if it's 7.5%, it's about $4.5 billion of sustainable EBIT every year, and you're paying $15 billion for the business. How many years does it take? Right, if they don't do something stupid with it. And are they buying back shares at a ferocious rate? What's happening to the share count here if you look at the value? They're buying back a ton of stock. So actually, even if these guys went out of business, the liquidation value is probably going to cover the $30 a share. If you look actually at the operating business, it takes no investment. It actually throws off the float. This is a real business that takes no investment. If it grows at 6% a year, and they pretty much devote everything to buying back stock, at this earnings power, that is an earnings power of $3 billion on roughly an $8 billion enterprise, you're getting a 30% plus current earnings return. A lot of cash protection. And this business, if you look at healthcare, is growing at least 6% a year organically with no gain. This is a 30% plus return business with no downside. By the way, the other downside that everybody worries about is not just the prescription, it's the small part of these guys. It's the change in the mix of the business. But if you've got a monopoly and everybody changes the mix, what do you do to the price you charge them? You just raise it. The nice thing about a monopoly is you don't care about the mix. You get your pound of flesh as long as you can keep somebody else out. And as the mix changes, that unavailability of revenue makes the market less attractive to your competitors and means that you can raise the prices in that mix. All right, the final bottom line is, and then I want to talk for 2 seconds and apologize for keeping you longer than I thought of. Brandon, yes or no? Yes, at $30 a year. Probably even today, it's not a bad bargain. It's like a 15% earnings return. Did the numbers matter here so much as where we started with Mark and Christine? That it was a business that was cheap, that everybody was worried about, and was it a bad business, Christine? No, it wasn't. The lesson here really is you get a very long way with a broad understanding of what's going on. The numbers will support that, but the numbers, if you get into them first, can also lead you astray. I'm sorry I ran over. Take off. Have a good time getting drunk. At least I'm 5 minutes early here. I'll take your question up here, okay?
Give up
Dan left. Oh, there he is. Dan, here it is. So you just have to email it.
Give you a line of
I have to know that. And that's right, because they have their business it's all right. It's 6% organization. No reinvestment.
Tu hai preso di un biglio, no?
It was about 15 cents. The average pay is about $70.
They
Figure a quarter
and they're like, oh, we're just starting.
Quanto hai detto che questo era a comprare?
I mean, it's not
No, io ho detto che era $60.
It doesn't make a difference. It's that franchise. What really matters? You want to come to my office?
Hey, what's up?
Serio? Devo pure visitarle la prossima settimana.
Turning something?
Who's got
What to say? That's questions. Like you're fine. You turned in something.
As long as there's your name on a piece of paper, that's okay. Cool.
And we'll put the hammer down. There's like 3 1-pages, one of which is in your book. You could just seconds. You're going to be okay. Turned in things.
I know what
This is like the easiest class ever.
Are you really going to at least look at them?
I looked at all the ones I grade. I actually look at all of them, and I read through. Like I won't make comments, I said, like, with what? If you make an attempt, you get a check. So, like, some people screwed up putts in general. Fine, check. There's one student, I won't say who, didn't even put a stock price in. And it was awful. I'm like, you have to do another. I'm just, no, I can't. This is
Also,
really bad.
if someone really screwed up, you at least replied and you
Yeah,
got
I
it.
told, but like everyone made an attempt.
I should check on my email then. If it's an email from you, no, try again.
But like, I mean, really, like, it's one of the easiest classes on campus ever.
I would say, like assignment-wise, it's easy. I'm in trouble with the growth scenario here.
That's, you know, it's a learning. The grade is supposed to be just like there because we have to give grades.
Yeah, no.
And yet, this class, people make it so hard. I mean, like, you know, we're like asking, like, we don't want to fail people, but like, what? I mean, it's just sort of insulting to have someone not even do more than 2. It won't be like 3 points even an H, but who cares? You'll be fine. You should be trying to do the big game to get an H.
There were a couple things.
What do you guys, yeah, let me ask a question. I'm not sure I got it, like, what the structure of the paper is.
We'll send something in. We'll make it pretty clear. You should try. Everyone should try, though. It's, guys, you're not,
I mean,
I don't want you to ask me any questions.
alright, it's been a long afternoon.
Thank you very much.
I was private equity. I know.
I mean, like, just fun. It's fun. It's all fit, so it's not.
Have a good day.
You're not. If you have questions, somebody else. You're not the guy. All right. This one is
Where is your first, like,
so which numbers were you saying? He has some shoes.
You guys?
I think so. I'm going downtown right now.
No, I don't have office hours. You can take a look at his slides right there, like right now.
Yeah, I didn't know.
Go for it. Take a look. Take a look. How are you gentlemen doing? Just looking sexy, and
It's Davis, man.
do you have any questions for me? Because I'll cut.
Actually, I'm wondering how.
Now, sometimes see, those are not
Have them single balance, and we're like, fuck. Some people, like, everyone's you know, when it's usually like, I've got a real estate competition. I'm like, he's like, I've got a real estate competition.
The only problem
It's
is
like, that's extracurricular. You can do it a month in advance. It's not like a surprise. And like, oh no. That's the thing. That's the thing is, like, I'm a complete pusher. Like, I'm here to help. Like, I'll sit here and work with the power all day long. This team, there's zero. And it's just like a complete insult. It's like, you know what? I don't get paid enough to be nice to people that much. Like, fuck that. Did you get the stuff you needed? Sort of. All right, cool.
Oh, it's 10,000 workers, 15,000 workers.
Like, people were like trying, like, oh, this wasn't.
I did the numbers wrong.
Is there a way like, to double check? I submitted 3 evaluations, but just want to make sure that you guys got it. You know, because there's so many files.
Right. Can you send me an email? BY's 10, and I'll check. But if you haven't, we'll let you know. Oh, I'm pretty sure. Most people have.
Because he said majority team. I was like,
Some people, very, very few people haven't, and they're like, I haven't submitted anything. I'm just like, so we are. We try very hard, like begging. This is like the easiest class ever, and it's just so you'll be fine. Everyone's gonna be fine.
Yeah.
So,
be thinking about
if we've screwed up, you'd let us know? Like,
did you submit 3?
I did.
Fine.
Okay.
That's all you need to do.
buddy.
Oh, thanks. Cool.
Like, you guys should be thinking about if you want to do the big paper.
Yeah, there was nothing about that. Like, is it in the syllabus? All the directions too?
For the big paper?
Yeah.
There's some.
Because last year it was a competition and you had to present it, right? I wasn't sure.
Well, they sort of, you don't present a final. You just submit it and they give you a prize for the best one.
Oh, really?
Money.
Yeah,
Money is
because I remember
great.
last year you guys participated. I thought there's actually
Yeah, for the last year's, you get like
yeah, Grant got like a whole bunch of money. So that's not. Is that the same thing? They give you a prize for that, or is there actually a presentation that you have to do as well?
there's no presentation. You get it's just this class. That's not purchased. It's not spending. It's just
Right.
this. And yeah, I think it's $2,500.
So it's just based on the paper.
It's the same. It's either that or he picks like 1,500 then 2,500.
Yeah,
Money.
I know.
And a good
That's
grade.
another reason to do it.
See it. So let me be clear, right? Because I know I'm coming across as an asshole, and that's cool. And like I don't care, but like I had second years asking me like, what are the books for the class? Like it's going to be on the syllabus. A gentleman emailed me this week and said, where do I pick up a second copy?
I'm going to check into that all, yes.
I'm like, well, probably where you picked up the
Yes.
first copy. Like, like really? Really?
It depends. How
I mean,
stable.
this class, I'm coming close.
The float is very unstable.
Multiple back and forth with this girl. She's like, this wasn't on the syllabus. I'm like, you know what? Figure it out. She's like, oh, my English isn't good. Well, you know, a lot of people, English is their third language got this class. I don't know what the problem is.
Stable as in lots of short time investment?
No. The float is
Yeah.
you get the insurance premium before you pay the medical. That means you hold the money. That amount of float shows up on the liability side of the balance sheet as policy liability. But as money went to you by policy,
I give up. Like, and I don't even. We didn't communicate that clearly. To be fair, WellPoint is not on the syllabus, and that's we didn't.
if that
the
float
syllabus,
is
it wasn't.
$6 billion this year, $6
Fine.
billion last
You know what?
year,
But,
$6
like,
billion the year before, $6 billion.
Everyone here
20 years ago.
has graduated from a quite prestigious, oftentimes, undergraduate institution. And they're at least one semester into a very prestigious graduate program.
And
As such, I get to be as angry as I fucking want.
That's from the liabilities.
No, that's from the
should make
asset
you
side.
feel-
Cash is from the asset side. The debt is from the asset
You see,
side.
it should make it.
But I did not include policy liability.
No, it doesn't. These kids are killing my brand.
Debt is just the interest rate. Policy
Oh, I'm cutting and
liability is
pasting.
the cost.
I'm like fast.
Fine.
Wait, which class? How many TA?
I know, I know.
How was ESL yesterday?
He's a whole over the place sometimes.
Pretty intense.
One of the people, like you said,
I gotta get the slides.
Not tomorrow. From now on, you can have a fourth class in college. I don't have to prepare the speaker. I just have speakers. So you can come before class or after class. There's a rule in my office. Now he's young. Oh, you're in my office. There's a mistake.
We'll take care of it. He's going to Karen and whoever we're supposed to go to now.
Right. And we part of this thing, right?
Listen, you were very generous. That's all I'm
Then
going to
do
say.
you understand where they're going to get their grades in this course? When they go to enlist.
I understand that.
And most of them are going to get really proud.
All I'm listening.
Oh, but you hear this guy.
yeah.
70% of it is the market, so shouldn't we be guessing? I know what's coming next. Shouldn't we be guessing the market?
It's
I don't know. I have no idea why this is.
I'm just
You see, the Legends class I could imagine going up because it's absolutely, you can't get those classes anyplace else. It's a smaller class, it's not in this scale. And that one didn't sound, why this one sold out.
look. I like this one. I actually like this one better than the Legends class because I think that some of the Legends are better investors than they are.
Oh, yes, but that's why you have to listen carefully. And that's why I do these little summaries at the end.
So
But taken together, if you listen to those 12 people, and you distinguish the idiots from the good investors, it's an unbelievable value. You can get this. And if you have a guy in front of you, the chance that you'll go off course, chasing superstars, is great.
No. That's why. So you for a brief, glorious moment in 2008, we placed all the people in the 41st century. It's the only year it happened. And then next year they all decided they wanted to have jobs with just this year. They started having trouble again because their aspirations. In this one, you got to start with that. But you've got to do a better job. Very easy to answer all companies. You ask questions of companies. You've got to seek out the people who are interested in cutting the analysis that you do. And then when they're looking for something, it is a big community. Lots of events that you have to go through. And you will go through. In those events, forget who you work for. You want to do a good job of the university, which is what is strong. And you want to do the analysis that keeps your job. And when you do the good analysis that does a good job, you want to share it. So it's in the network. And that's what you want to do. And it's unfortunate. In these times, it's not too bad. You'll all be back.
I'm hitting that level of desperation. You know, I'm going to get something shit. So I feel like, yeah, okay, it's right around the corner.
Yeah, absolutely.
I think I'm not. So, we got this. We'll collect all the papers. We're going to send out an email about the papers, the long papers.
Okay, what you do is, if you just remember, you're doing absolutely the right thing. What you next have to do is just go down the list and say how many things people have. And on Tuesday, when the American Express things come in, and then just say these are the other papers. Just send that. Okay? And then you're done. So you've done a great job. I hope it wasn't too honest.
Look, it was the owner's part is not the grading. And I answer questions on earning power and asset value. Gentlemen, you might appreciate this email. The gentleman said, I'm going to go through this in my locker. Where can I pick up extra copies of the course? And I responded, probably the first time. But there was a number of questions on that level. Maybe,
No, Dan, next year, just they ask stupid questions. Or hand them on the signal.
She's got to work on her anger, so we're balancing it out. I have too much, she has not enough, and so we're have some sort of.
But I don't this.
Yeah.
Or send them.
Yeah, well, that's my. I'm fine with it. That's my job. I figure I'm paid enough to deal with them, but not paid enough to be nice to everybody. So.
Well, keep track of your horrible hours, and we'll brace it.
No, it's fine. This is fun time. Okay. Thank you very much. I got everything.
Great. Thank you, Ben. All right, let's go.
Gentlemen.
I just got that's right. Yeah, I don't have to talk very long. I just want to. Okay, let's do. Tell me this down.
So, I wanted to. I've got all the places where the different times. I just wanted to get it in the format that I can.
Okay. So yeah,
I don't want to. When I get it at that point, but I don't want you to lose confidence.
No,
work is between me and my wife. So as long as you know that.
Yes, that's fine. That's fine.
I'm going to send it to you and say Thursday we'll go through these questions or something.
Anytime. We're not in.
All right. As long as
I don't have. I've submitted the grade already.
Yeah.
So we're not in.
I didn't want to lose that. I still want to come in. It's actually the good thing is I'm finding this is valuable. Your messages are consistent. So what we did, some of the themes within globalization and how to do it applies that will apply here too.
I think it's
okay.
Are you going to see it on this question?
Yeah, I just checked them the other day. I don't think it's.
Is it from his office?
I don't know. I've never been in his office, but so in terms of other funds, I'm just trying to think of some places that I haven't gone.
I'm getting no traction.
I mean, you're not alone. Okay, let's be clear.
Yeah, but
Okay, I would find that normal if I hadn't have had any success on shows. So I think something in the premise, unless it's the law of great numbers, right? I mean, look, I fully understand that maybe the best people were applying for jobs I was applying to. I didn't know what the answer is, right? But the truth is, I've sent out like 4 or 5 applications. But I always send them out late, like on the last day.
So I apply whenever things for the off-campus stuff as soon as they come on.
Yeah, you see, that's what I'm doing.
I don't.
I apply the last day.
I don't know if that's correct. I think that because I just assume some people deal with things on a rolling basis, although that's not always the case.
You see, my question is just, I applied to Stein, I applied to Pazina.
I haven't heard from Pazina. Just give me names, I'll tell you if I've heard from them.
I applied to Pazina, I applied to Savoy.
I didn't apply to them, and I can't remember why not. But
I applied to the last one. I applied to, I think that was it.
No, Pazina, the deadline is pretty far. Okay, maybe it's not.
It was only,
Okay.
2/7 to 2/15. Savoy, I applied to. Do you chase them up? Do you call them up? Or is that heavy?
No, I don't, and I think you should.
Yeah.
So the way I would do this is I word my things like, when I was really on my game, really aggressive, I said, hi, this is my,
Yeah, I'll be following up.
I'll give you a call next week to discuss. And that was sort of the way that, it was a forcing function, was they sort of see that and they'd be like, they'd quickly say, sorry, not hiring, just make sure I didn't call back.
So you heard back?
No.
Statistically, how have you been coaching?